Welcome back to another episode of the Isn't That Rich podcast. It is 2024, so we are learning all about the new laws and new taxes, and we just want to talk about taxes in general, especially about your personal taxes. So we're going to be talking about deductions, refunds, tax credits, all those fun things you need to gather up for your tax professional.
For the season.
So you have the best tax season of your life. Woo! And we have a very special guest, Mr. Matt Businaro, our CFO at Farmers State Bank. So thanks for being back with us, Matt.
Glad to be back.
Thanks for being on.
Mm-hmm.
You know, funny, that you mentioned the season. A lot of folks think that Christmas is the most wonderful time of the year, the most wonderful season of the year. It actually really is tax season.
Is it? I heard you guys work like 14 hours a day.
Yeah,
maybe even longer.
That's pretty accurate.
Is your Christmas April 15th? Is that what it is?
Yeah. Yes.
Christmas Day, right?
Yeah.
No, but I was talking to Ashley about this earlier, and if we can get right into taxes and income and deductions and all that stuff, but a lot of people, in what I've seen, don't love to pay taxes or claim income and pay taxes on that income. Like, I have a story for you, because I was at the grocery store in Goreville the other day, and some lady, Tom's wearing his Farmers State Bank sweatshirt like he wears.
Classic.
And some lady came up to him and was like, my husband and I are trying to get this home loan, but we can't because we run this construction company on the side, and it just shows that he doesn't make that. We don't claim all of his income on our taxes. And Tom's like, stop right there. Like, I just have to walk away because it's essentially tax fraud, right?
Yeah. That's exactly right. Just because you don't get a tax form with income on it, or just because you have income that's not reported on a tax form, doesn't mean it's not income. And to your point, a lot of folks will not report all of their income if it's not reported on a tax form, and it's tax fraud. And
what a way to start an episode. Sorry, I had to just slip
You're
it in
all
there.
going to jail.
And just because you don't necessarily get caught now doesn't mean you won't get caught, one. But two, to your point, if you're wanting to get a mortgage or any sort of loan, one of the first things you're going to be asked for is, okay, let's see a copy of your tax return, because that's how a banker is going to evaluate your ability to repay the loan, is to see
how much money you're making.
What you're making, right? And so if you underreport your income, then we don't have an accurate picture of what your true income is. And so even though you may be able to say, well, I really made $50,000 more than that, that's great, but we have no way to prove that.
We don't just take your word for it at the bank.
No, that's for sure.
We're not allowed to do that.
No.
That'd really mess us up bad.
There may have been a point in time when handshake loans were the norm. And we do feel like we are very efficient and easy to work with, but we're still going to need some proof before we're going to be able to. There's just too much risk involved in making a loan if you don't know, don't believe that the borrower has the ability to repay that loan.
So I guess that leads to my first question. What should I be reporting as far as income goes on my tax return?
The easy answer is all of it, right? The IRS does try to make it easy on us to fulfill our compliance responsibilities, and so there are a variety of types of income that are going to be reported on a tax form. Obviously, if you're working for an employer, they're going to give you a W-2 that shows everything you made during the year. The banks and other institutions where you may have investments are going to give you a 1099 that's going to report all of your interest and dividends and other sorts of investment income. If you're an independent contractor and do work for a business, they're going to provide you with a 1099 that says this is how much I paid you, because they're legally required to provide 1099s. They can get penalized if they don't. So they're going to give you and they want to be able to deduct those expenses. And so if they're going to be able to deduct what they paid you, they've got to report to you what they paid you.
Right.
But you do stuff on the side for individuals. Individuals don't have a reporting responsibility to provide 1099s because they're not running a business. But nonetheless, that they paid you for work that you provided them, then that is income for you. And so you are required to report that.
So let me dig into that a little bit deeper. So I'm a lawn mowing company, and I mow your lawn every and you pay me, but I don't give you an invoice or I don't. So how does that work? I have to present you with the 1099 at the end of the year?
No. If I'm a business,
okay,
and you mow for me, and I pay you more than $600 or more, then yes, I am required to provide you with a 1099. But if you come mow my house, I don't have a home office or home business, then no, I'm not required to provide you with a 1099. And so at that point, it's your own honesty to be able to do that.
Okay.
Likewise, think about where you get your hair done. They're required to report that income, even though there may be a great amount of cash involved. If they use a payment service like a credit card, the credit card companies are going to provide them with a 1099-K form at the end of the year that shows each month the number of payments that were processed for your business, and so they're going to have that part of it, but they're going to get a fair amount of cash due. They are supposed to. The law says you're supposed to report that income. So.
Yeah, I even saw, what was it on Venmo, that anything over 600, if you got over $600 in transactions or deposits in your Venmo account, that's something they have to look at this year too.
Right. Venmo,
right.
PayPal, all those sort of online payment venues are going to provide that.
Yeah. Interesting.
Wow.
So if we're tax planning for 2024, and I think this is everybody, it's the beginning of the year. A lot of people like to get their tax refunds early on in the year. What can people do, or what do they need to provide for their accountants, whoever's doing their taxes? What do they need to provide? Like, what do I need to give them to do my taxes?
Absolutely.
What do I need to have?
Yeah. So the tax forms we talked about are first and foremost on the list. What I actually do personally for myself, I've got an accordion folder, and all throughout the year I'm gathering documents, because not everything that I do is going to be on a tax form. So think deductions. If I'm making a charitable contribution, you'll see on Facebook a lot where you'll have a friend who, for my birthday, make a donation to the ABC organization, which is not an actual charitable organization, but they'll
probably is somewhere in the world.
ABC.
Yeah, pick one. They're saying for my birthday, make a donation to, instead of a gift, make a donation to whatever organization that I'm really passionate about. So if I do that, and I'm going to print up the copy of the receipt, I'm going to file in that accordion folder. Real estate taxes are a common one that people miss because they don't happen right at tax time. Pay those, drop them in the accordion folder, and so that way you've kind of got a head start on some of those during the year tax items. Even any kind of deduction, medical bills. If you pay a medical bill, and you've got a paper copy of that, drop that in the accordion folder.
A medical bill.
Medical bill. So, anything that's not covered by your insurance that you had to pay out of pocket, drop that in.
For
me,
why?
Because that could be a deduction.
Could be a deduction.
Actually. Yeah.
I'm learning this. This is what this episode's about. I want to know all the things.
We'll get more into that a little bit here in a little bit. But that's these are right now I'm talking about what to
save and track.
So my daughter's in college, right? So whenever I pay a tuition bill or a book bill for her, I keep those receipts, and so just accumulating things as the year goes on. Then when you get towards the end and you think you've got everything and you're getting ready to take it to your tax advisor, frequently, not always, but frequently your tax advisor will provide you with a document that's called a tax organizer. They may call it something different. They may call it a checklist, whatever. A lot of folks will just kind of toss that like, that's complicated, I don't want to look at it. But it can be super helpful to help you make sure that you've got everything. So usually that tax organizer will list everything that you had last year. And if there's not a lot of change from the prior year, it's a good, really, really good guide to go off of. You don't necessarily have to fill in the dollar amounts, but I would recommend using it to organize your information. So you can go through, okay, well, I've had these W-2s last year. Here they are. Let's start the stack. Here's all the interest forms I had a year ago. Yep, here we go, A, B, C, D. Put it in the stack. I had investment income. Oh, that hasn't come in yet. I need to probably hold off on filing my taxes until I get the investment statement. And those generally do run later than everything else, just due to certain characteristics that are inherent with investments. Sometimes they're not able to provide that to you immediately by January 31st, like the other 1090 forms are due. And so that may be something that might hold you up a little bit. But just kind of go through those things and see, here's what I had a year ago, so I should probably have these things again this year. And if you'll follow that and get everything even in the order that's in the organizer, it'll make your tax preparer's job a lot easier. It might even save you a little bit on your tax prep fee. The more organized you are, the more work you do for them, the less work they have to do.
The less hours they spend right on you. Is that how I guess I don't even know how accountants charge. It's not hourly, or is it hourly?
Some charge by the form. Most, in my experience, charge by the hour. So, the less hours that they spend, the lower their fee is likely to be.
Okay. Good
Funny story. So it's a W-9 you turn into your tax advisor, right? Or W-2.
W-2.
W-2, sorry. I get it mixed.
W-9 is a form, though.
Mm-hmm.
So.
I know. I think I filled one of those out one time. Yeah. Or a couple. My brother, my mom, got his taxes done, I guess. And it was the day after. I don't even know how the guy did his tax. I don't know. That's a whole nother story. But my brother, the next day, calls my mom after she's paid for
taxes to be filed
and all that. My brother goes, "Oh, did you need this W-2?" She goes, "All right, well, you can cough up the amount of money that it costs to redo his taxes." She's like, "Dude, that's how you learn lessons, though, I guess, with taxes. Some forms are due."
Yeah. I think you learn more from your mistakes than you do from doing things correctly. So you don't tend to forget those. Sure.
So I love what you said about you organize yours in an accordion, just a file, one of those accordion files I'm imagining with the little string that you tie on the end. And so do you recommend Marion. That? I think so. So if you were to get that list, you just talk to your accountant on that and then you just keep your separate files? Because you said there was if your accountant typically has a list of things, checklists or something.
Usually they will send those out towards the end of the prior year. So I'm expecting that I'll probably get one, anytime now. Not always. Sometimes it'd be more towards the first of the year, but I guess you almost have to be mindful though, because that comes out so late in the year of, hey, is this something that I might be able to deduct? I might want to be able to find this later when I need to produce it, so that I can get the deduction. So it's just kind of getting in the mindset of, hey, I paid this bill, I might be able to deduct this. Probably ought to stick this in the folder so that it's there and ready whenever the time comes.
That's good.
That's crazy to think that there's things that you could have that you're not keeping that you could deduct.
Oh yeah, for sure.
I feel like I'm learning that as I'm getting older, charitable giving or you name it, keeping those things like medical bills. I had no idea about that. I just don't know. I mean, Matt, because you're a CPA.
I did taxes for 20 plus years. So yeah, I've seen some things for sure.
So let's talk about some of those deductions or things that do qualify for deductions when it comes time to do your taxes. So we mentioned medical records. So you said anything that your insurance doesn't cover that you pay, you should save that receipt or that statement, correct?
Correct. Yes. So if you have health insurance, then of course you're going to have a deductible that you're going to have to meet, and then beyond that there may be some additional out-of-pocket expenses as well. So anything you're paying out of pocket that's not being reimbursed by health insurance, you'll want to keep that, and so that you are able to deduct that. Medical expenses can be a little tricky. There's a floor above which your expenses have to be before you can deduct them. I believe it's 10% of your gross income. So you have to have usually a pretty serious illness to be able to deduct anything, but it's still worthwhile to keep track of those just in case you do get over that 10% of your AGI.
So threshold. I can't turn in my $30 copay from.
You can,
you're just saying it's probably not.
You can, but you may not.
They aren't going to do not hit that threshold.
If you have enough $30 copays, though, I mean, if you're going every day, then, you might have something there. Or if you have a major illness and you have a surgery and you have a big out-of-pocket amount, those are probably things. If you're just going for a routine checkup twice a year, probably not going to be much of a benefit. But if you have a major surgery with some hospital stays and
ambulance ride.
A big one would be the helicopter, right?
Oh, yeah.
If you don't have air vac insurance, which not to plug any particular company, but is a really good idea. By the way, the premiums on that would be a deductible medical expense.
Okay.
The out-of-pocket for that, it can be really, really high, like 5 figures. And so that if you have to take the helicopter and don't have the AirVac membership, then you're probably going to have a deductible medical expense that year.
Yeah.
So
okay.
What about Botox and lip filler?
Cosmetic would not be deductible.
I figured.
I think there may be some limited exceptions there, but if it's just purely, as a result of, I don't want to look 45 anymore, so I'm going to get something done for vanity. There you go. It's not going to be deductible.
But maybe something like some other stuff that we think of, like if there was a breast cancer or something like that, could qualify for.
Correct. That's a different situation for sure.
Absolutely.
Definitely.
Consult your tax advisor.
Consult your tax advisor. Keep your
Consult
receipts.
your tax advisor. I guess I skipped the disclaimer.
Yeah.
I am not a tax authority like the IRS or the Internal Revenue or the state taxing authorities. So please contact your tax advisor if any of these topics that we talk about today seem appealing to you, to get their advice.
Good disclaimer.
Thank you so much. What's another deduction besides medical?
Okay, so state and local taxes, real estate taxes are a deduction as well. Again,
this is what I was trying to say.
These things are what are called itemized deductions. So the IRS gives you a standard deduction, and I don't have those amounts memorized. I apologize, but the IRS gives you a standard deduction. The amount varies whether you're single, married, single but have kids, with what they call head of household, married filing separately. Some folks are married, but they file separate for a variety of reasons that we won't probably get into too deeply today. The amount of your standard deduction varies depending on your circumstance. So medical is an itemized deduction. So your itemized deductions would need to add up to be more than the standard deduction that the IRS gives everybody in your category.
Yeah.
So assuming that your itemized deductions are more than that, here are what we got. So state and local taxes. So your real estate taxes on your personal residence, your state income tax that you pay.
I have a question before we move on to personal or from personal real estate. So if you have second homes, does that qualify for deductions?
Yes.
So you're paying real estate taxes on second homes. Yeah.
That would
as long as it's not your business.
Correct. Okay. And if your second home is a business, then, or like you rent it out for Verbo or something like that, that would be deductible still, but in a different way. Different schedule and different way. Correct. Okay. Sales tax. So let's say you are building a house and pay sales tax directly for the items rather than paying your contractor buying those items. That could be significant. If your sales tax you pay is more than your state income tax, then you get the sales tax instead. Or if you buy a car, any sort of big ticket item, accumulate those sales tax so you can evaluate if the sales tax is more than the state income tax you have withheld from your W-2.
So it actually adds all those purchases up, correct? So it's like, here's your car, here's your home supplies that you built your home with. Those all add together to meet that threshold. Is that correct?
Correct. So all sales tax paid. That being said, the maximum deduction that you're going to get for all of those items is $10,000. It used to not be limited, and they have changed that to where it's just a maximum amount of $10,000 of combined real estate taxes, state income tax, and or sales tax.
Okay.
So. Mortgage interest. So you're building a new house. You're paying interest on the mortgage on that. So that is an itemized deduction that you can get. And with mortgage rates where they are currently, that is maybe a bit of a higher deduction than maybe what it's been in the past. So that's a benefit for you.
Even on my construction interest.
Any interest?
Because that loan is secured by the value of the real estate and what your home is going to be worth when it's done. So,
because if you are, so we talk about this with our Kasasa accounts. So we get paid, or you earn rewards, and you get a statement at the end of the year about how much your bank has paid you in interest. So same thing, you have to report that as well, correct, as earned income. So, correct?
Yeah.
Yeah.
Correct.
Yeah.
But this would be a
opposite
deduction.
way.
The opposite way. Right. Interest received is income. Interest paid for a personal residence is a deduction. And if you have businesses that you report on your personal income tax return, interest you pay associated with those would be a deduction as well on whatever schedule you're reporting that activity. So, other deductions. Let's see. Charitable deductions. We said that's a big one. There's no real. There are some limits on it, but it's usually based on, like, if you pay your contributions are more than 50% of your income, you might be limited on how much you can deduct of charitable contributions in a particular year. There's different categories there, but for most folks, they're not going to be donating that much, and so there's for all intents and purposes not really a limit on your charitable giving. So organizations are required to give you a statement at the end of the year. If you give above a certain amount, I believe it's $1,000. So, like if you tithe to your church, they should provide you at the end of the year a report showing that you gave X number of dollars. And usually it's an itemized list that says, every week,
payment.
every payment. Here's what you did. But if you do smaller ones throughout the year, like I said, your friend on Facebook wants you to donate to the Wildlife Fund, then print that up and
because they're not going to send it to you.
They're not.
But you're saying if it's over $1,000,
it's got to be over $1,000. I believe the amount.
I have a couple of charitable questions or charitable giving questions. So you go to Goodwill, you drop off a bunch of stuff, and they ask you, "Do you need a slip?" Mm-hmm. What is that? Does that have anything to do with deductions, or is that even qualify? I don't know why they ask me that.
take the slip.
Take the slip, but what do I report?
I mean, they are supposed to provide you with the value of what you gave them. They never do that. So at the end of the day, it's up to you to kind of put a value to that. I believe that the Salvation Army, at least they used to on their website, have a sheet you could print up that gave an estimate of what the value would be. So if you should be wise to go in and try to inventory those things before you donate them, so you can kind of assign a value to it. But they really don't want to stick their neck out and provide a value, even though that's what they're supposed to do in a situation like that. So it's a difficult one.
I've never asked for a slip, but they always ask me, and I never say yes. But maybe I should itemize my stuff, I guess. I don't know.
I mean, for me, the benefit of getting rid of it's
outweighs
bigger than the tax deduction
the
I'm
tax
probably going to get.
For sure. For sure. That was my first question. And then my other one about charitable giving is, so, you see these GoFundMe pages out there all the time, and you might give that way. Does that qualify for you for a deduction, a charitable giving deduction?
Unfortunately, no. To be deductible, the donation has to go through a qualified 501c3 organization. So really, if you do a GoFundMe, that's usually straight to the individual. That's. I mean, not that it's not a good thing that you shouldn't do,
right?
But it's not going to be a deductible donation.
Well, that's a good thing to know.
Yeah,
it's got to go straight there.
Yeah.
There are 501c3 organizations that will provide assistance to folks, and so that is a good way to support. Give the money to that organization, and then say, hey, for certain individuals, if they qualify for assistance, kind of lead them in that direction, and so you can indirectly
give them the money,
right? But you're doing it through this 501c3 charitable organization.
Interesting.
What other deductibles, Matt, that you're collecting throughout the year?
Yeah, so if you have a health savings account, let's say you've got a high deductible health plan through your employer, then they will oftentimes allow you to have a health savings account in coordination with that. So any sort of contributions that you make to the health savings account would be deductible, and there will be there's actually a tax form on that will be available from the the institution that administers that you can print up that will show the contributions that were made to that during the year. But that is a big one. Like I mentioned earlier with my daughter Ava, the college expenses, keep track of all of those for a number of reasons. There are education credits that are available if your income is within a certain range that you can qualify for. There's the American Opportunity Credit, which I believe is $2,500 of the first $4,000 of qualified tuition and fees that you pay. So that's one thing that you might qualify for. I think there's also the lifetime learning credit, which is the American Opportunity's first 4 years of college. Lifetime learning is outside of the first 4 years of college. There's also tuition and fees deduction as well. And again, these you have to be in a certain income range to qualify for that. If your income's too high, you're not eligible for those credits. But still worthwhile to keep those receipts so that your tax advisor can evaluate whether or not you qualify for any sort of tax deduction there or credit.
Okay. So you talked, is there any other deductions? Because you kind of moved on to tax credit, and there's a difference, right? So deductions versus credits. Maybe you could talk about that a little bit. Like, what is the difference?
Yeah. So a deduction is going to, in essence, to see what benefit you get from it. You take the dollar amount of those deductions, multiply it times whatever tax rate you're in, and that's the benefit you get. So let's say you've got $25,000 worth of deductions and you're in the 15% bracket, then you're going to get let me test my ability to do math here, $3,750 roughly benefit from those, right? Maybe I did that wrong, but.
Do you need my calculator?
Yes.
$3,750, pretty confident. That's 15% of $25,000. Whereas if you have a $25,000 credit, that's going to reduce your tax liability by $25,000.
Okay.
So some credits that are available, and with credits, some are refundable, some are non-refundable. So a non-refundable credit will reduce your tax liability, but not below zero. So let's say you've got a $5,000 tax liability. When you calculate, take all your income, subtract out all your deductions, get to taxable income, multiply it times your tax rate, your tax liability is $5,000. If you have non-refundable credits that are $4,000, then your tax liability gets reduced to $1,000. Then you look at how much you paid in, and that helps determine what your refund is. If it's a refundable credit, let's say you've got a $5,000 tax liability, you've got a $6,000 refundable credit, it will completely wipe out that $5,000 tax liability, and you'll get a $1,000 refund on top of it. So different credits, can be refundable or non-refundable. To find out whether one that you qualify for is one or the other, consult your tax advisor, because I don't have a laundry list of which ones are which.
Right.
But I can tell you some are refundable and some are not. So education credits, big one. The child tax credit is a big one. Your kid is younger than 16, then they qualify for the child tax credit. But there is I think, a dependent credit for those that are over 16. It's not quite as robust as the child tax credit is. And the child tax credit, the amount you qualify for, again, depends on what your income is. If your income gets above a certain point, you may not get the full credit, but it's still pretty nice.
So you get a credit for having a kid if they're under 16.
Correct.
I didn't realize that. Remember, we had this Smart Women Finish Rich, and there was a mastermind, and one of the ladies in there said, well, I don't pay taxes. My child tax credits cover all my taxes. And I was like, well, you still have credits. I mean, you still have taxes, but that just, like you said, outweighs the liabilities, I guess, that you have.
Maybe she had enough kids to where it was covering all of her taxes.
Yeah, and does it matter how many kids you have? Do you just keep getting bigger and bigger?
Is that why people have a lot of kids?
The expense of having a child is much more than the credit you get for it. It's no
not
way
that big of a benefit.
You take everything you're given, though, right?
Yeah.
And interestingly enough, I have a friend, a dear friend, who had a child who was born on December 31st and of a certain year, and they got the full child tax credit even though the baby was born on December 31st. So it's whatever year you're born in, you get a full. It's not he didn't get a 1/365th of a child tax credit. He got the full
year
$2,000 child tax credit for the full year, even though the baby was born on December 31st. So that's kind of he was pretty excited about it. The flip side of that is the year they turn 16 on December 31st, you get nothing, even though you were on the payroll for the full year.
Yeah. So, oh man.
Anyway,
that's good. What other kind of credits are there besides the child?
There's earned income credit, which is available to anyone who is a lower income individual. I think you've got to be 24 years of age or older to have that. So you don't necessarily have to have any children to have the earned income credit, as long as your income falls within certain thresholds. The more children that you have, then the amount of credit will be higher, and you can be eligible for it with a higher income amount than if you don't have any kids or fewer kids. So that's always a complicated one to exactly explain. Just realize that it's something that you may be eligible for, and that's why it's important again to use a tax advisor, maybe more so than do your own taxes, because they can make sure you get everything that you're eligible for, maybe better than you can do yourself.
Right.
So.
Yeah, because what if it's like a stepchild? How's that work?
Yeah, right. Exactly.
I'm throwing you into the fire right now.
And if you'll notice, I'm deflecting on that one. That is certainly something that
might depend on your marital status, probably all that.
Your marital status,
and who has custody,
what the divorce decree says, because you may alternate. Being able to claim the kid every other year.
Yeah, is it shared custody or is it sole custody? Yeah, all that kind of stuff.
There's so many variables.
Yeah,
crazy.
So I can't give you an answer to that one other than to say it depends. One of the gentlemen that was presenting in our tax seminar last week, his favorite answer just about everything was it depends. But my favorite answer is consult your tax advisor. His favorite answer was it depends.
It depends.
So,
Any other credits we should know about?
Those are the big ones. There maybe are some other minor ones, but those are the ones you most commonly see. We talked about energy credits in the podcast we recorded earlier, so there are some energy credits as well. And I'll just briefly touch on those: doors, windows, skylights, insulation, energy audit, which is a new one. Those are eligible for some energy credits. Additionally, solar and some other sorts of types of high energy efficiency heating and cooling units are eligible for some credits as well. And then there's starting in this year, there are some electric vehicle credits that are a little bit different than maybe what has been around in the past. So again, consult your tax advisor. Always best to get their advice because they're going to be familiar with your tax situation before you jump into anything. Back when I was practicing, so many times people would come in with a situation and it'd be like, well, you already done it now. There's not really a whole lot I can do for you. If you had talked to me before you decided to go down this road, we could have planned and structured things a little bit better to where you might not have got hit so hard as you are now. So just always good anytime you think about doing anything of any magnitude to talk to a tax advisor first to make sure you do it the right way.
Right. I like to think, so we all try to save for the future, and we talked about this a little in the episode, but I want to talk about it again because I think it's important. We're saving for our retirement. We're saving for our futures. Are there any kind of implications to contributing to retirement accounts or, I don't know, like your IRA or your 401k? Like, well, how does that work? Are there benefits to doing that? Because I know I read somewhere once that the government wants you to contribute to those to be able to retire eventually. So,
sure.
So tell me about that.
Sure. Yeah. Because if your expectation is I'm going to retire and live off of Social Security, which may have been true of our grandparents or even our parents, maybe, that's probably not realistic. To think that you can live off of Social Security alone, unless you have just a very simple, basic lifestyle. But just the cost of medical care and medicine everything's just more and more expensive, and the Social Security benefits just aren't increasing as quickly as inflation is.
Yeah.
So,
Well, I mean, you can look at it right now. You can go in there and type in your income level and when you plan on retiring. I think I make like $16,000 a year in Social Security right now. So, I mean, you know what I mean? If I were to retire at the age I want to, that's how much I would be paying.
Right. Of course, they're basing that off of what your earnings have been thus far in life, and obviously you probably got several more years to put in before you're going to draw. So that number will change all the time. But still, the point is, it's not a big amount. So you need to contribute to a retirement plan of some sort, or save, you just need to save. It's just, you never know what tomorrow holds, much less 10 years down the road or 20 years down the road. So my advice on retirement planning is, if your employer has a 401k, get in it as soon as you possibly can. I know in our plan here at the bank, you've got to be 21 years of age before you can contribute. So, and that may be law. That may be the minimum age for all retirement plans. I'm not savvy enough to know 100% on that. But once you get to be 21, if your employer has a 401k or some sort of retirement savings plan, do it, and do the maximum amount that you can contribute. It may seem like it's really painful, but I'm telling you, because of what the markets do and the way they grow, or the time value of money, you lose so much by not starting as quickly as you possibly can. And you do want to retire and have the most amount to live off of. And so it's just so much worth it to take the pain now for the benefit that you're going to have later. Okay. And a lot of employers will have a match. And so you want to at least put in what their match is going to be. Because that's basically free money to you. And so to not take that would be, in my opinion, foolish. So you at least want to do that, but you really want to try to do the maximum amount that you can afford to do. For sure. So those earnings will accumulate in the 401k plan. And so when you retire, those funds are available for you to draw out for your living expenses. 59.5 is the earliest that you can draw without having a 10% penalty. And when you get to be, I think we said 73 is now the required minimum distribution age. Once you get to be 73, you have to start taking out a minimum amount, like we talked about earlier. The IRS knows how long you're going to live, and so you go to their chart and find out how long you're going to be with us, and divide the balance of your 401k or IRA, whatever type of retirement plan, by that age, and that's how much you have, the minimum amount that you have to take out. Now, you can take out more than that, but you have to take out at least that, and that's the IRS's way of making you pay tax on money that you contributed tax-free.
Okay. So if I am contributing to a traditional IRA, and how does that work? I know they say save that, whatever you paid in taxes, right?
Paid into your IRA.
Yeah.
Is that a deductible?
Is that a deductible? Is what I was trying to say.
It can be.
So
so save your receipts on that, I guess, is what you're trying to say.
It depends. So if you're a participant in a 401k plan and your income's of a certain level, you may not be able to deduct that contribution, but that doesn't. But you're still able to allowed to contribute up to whatever the maximum IRA contribution in a particular year is. If you're unable to deduct it, basically all that does is it gives you what's called basis in your IRA, and so whenever you take a distribution out of your IRA on down the road, a portion of what you take out will not be taxable. You'll pay tax on the earnings, but not on the contribution portion of it. So, and we also didn't talk about Roth IRAs. There's Roth IRAs, there's Roth 401ks. No deduction when you contribute to those. The beautiful part about those is, though, whenever you pull that money out later on, there's no tax paid on not only what you put in, but also the earnings on that. The decision point on a Roth versus a traditional is, where do I think I'm going to be in the future, right? Because you're going to pay tax on, if you contribute to Roth, you're going to pay tax now on what you put into it. So am I in a higher tax bracket now than I'm going to be when I retire? If I am, then I probably want the tax deduction now of of a traditional because when anything you contribute to traditional IRA or 401k, you get a deduction for now. If I think I'm going to be in a higher tax bracket when I'm going to pull the money out, then I want to do a Roth because I'm in a low tax bracket now, so I don't mind paying tax on that money now, knowing that later on down the road I'm going to be in a higher tax bracket and I'm going to benefit from taking that money out and not paying any taxes on it later.
So that's good for people to know is what you get taxed on what your income is when you retire, not when you put it in, correct?
Right.
Yeah.
Right.
Yeah.
But to full disclosure, not everybody can do a Roth IRA right now because they might make too much money.
Correct.
So that's another thing.
So that's a good point. So, but what you can do if you have a traditional IRA is roll it into a Roth IRA. So you can still get the Roth benefit. So there's a couple different things you can do. If you made a deductible IRA contribution, you can roll that into Roth. What you'll have to do is pay tax on the amount that you contribute, that you convert from a traditional IRA to a Roth IRA. But still, if you think your tax brackets is lower now than it's going to be when you retire, it may be worthwhile to convert that. If you are making a non-deductible traditional IRA contribution because you are a participant in a 401k, and so your income's too high, and so you're not eligible to make a deductible traditional IRA. But that's the best of all possible worlds, because what you can do is you can contribute to a traditional IRA and immediately convert it to a Roth IRA. Because you didn't get a deduction for making the traditional IRA contribution, you won't have to pay any tax on it when you convert it to a Roth IRA. And so if you're willing to jump through the extra hoop, even if your income's too high, you can still make it a Roth IRA contribution. You just have to go through
what is
steps.
that? The back door?
Back door. Yeah. I'm impressed.
Thanks.
Way to
Yeah.
go, Jill.
We have this podcast where we're learning.
I was going to say that, but I didn't want to sound like I was watching some
Isn't that
TikToks
rich?
about tax.
Rich.
Yeah,
I love it. Yeah.
Oh, good.
I got a question, and I'm just going to. How do you find out? Like, I just think everything's so hard. How do you find out what tax bracket you're in?
Okay.
Where does that show up at? Do you Google that? Is that on your
absolutely-
tax bill?
you
What is
absolutely
that?
Can. Yeah, that information is relatively widely available. So I would recommend Googling
So it's actually not that hard.
2024 IRS tax brackets, and it won't even link to an article. It may just pop up on the screen and show you what those tax brackets
It's even that. It's that simple. So I just haven't tried to look for it.
Yeah. And so the way tax brackets work is there are certain levels, and so the first X number of dollars is taxed at this percent, then the next X number of dollars is taxed at this percent, and you just basically keep going up. And there's 4 or 5 different tax brackets.
So they don't tax you on your entire. I mean, I know you're getting taxed on the entire thing, but you might get taxed at a certain bracket here, and then this. You're saying you're taxed more on that, and then more.
Yeah, it's like in layers. So we don't have a flat tax. So if you're
Right.
in the 35% tax bracket, everything's not taxed at 35%. It's just the top incremental parts taxed at
Yes.
35%. So it's in layers. So you'll have really, it's like a blended, when you average it all out, a blended tax rate of something less than 35%.
It's like our Kasasa account.
Yeah, exactly.
Yeah.
You get a blended rate after.
You get a blended rate.
After $10,000.
Yes.
That's good to know. So can we say that again? So your first, say the first amount that you make is taxed at a specific
It's
bracket.
taxed like, I think, 10%, and then the next so much is taxed at 15%, and then it just kind of goes up from there.
So if you're, a millionaire and it's taxed the same up to that certain threshold as everybody
Right.
that makes less than you.
Everybody that has at least the maximum amount of that lowest tax bracket will pay 10% on that amount, and then so on and so on.
Got it.
But once you get to the highest tax bracket, everything from that point forward is taxed at the highest rate. So your blended rate is going to be higher for a millionaire than it will be for maybe somebody who makes less than that. But it's a same system for everybody.
But I think I'd still rather be a millionaire, Matt.
Yeah, well, so when I was practicing, I always thought it was funny. when people were like, yeah, I got to spend X number of dollars to get my taxable income down. And I think they truly thought if I buy a $100,000 piece of equipment, my tax liability is going to go down by $100,000. No, it's going to go down by 100,000 times whatever tax bracket you're in. So even if you're in the highest tax bracket, it's going to save you. You're going to, if you hadn't spent that money, you might pay 35% on that $100,000, but you're still left with $665,000.
Yeah.
So do you need to spend $100,000 to save $35,000? Now, there might be a legitimate reason for it, like. I
need a new combine.
I knew I need a new combine.
Sounds like this is my dad. This is my dad.
Yeah.
And so, it's that time of year when I'm thinking about that. So then the question becomes timing. If is my income higher this year or is my income going to be higher next year?
Right.
Maybe I want to wait till next year to buy that combine because I know, I've got a lot of grain in storage that I'm going to wait for prices to get to a certain point I'm going to sell. And I had a better year this year than I did last year. And so I know my income's going to be higher in next year than it is this year. So I'm going to wait until after the first of the year to buy that. Whereas if I know this year was a dynamite year, I don't know what next year looks like. And I know I need this piece of equipment. I'm going to do it now.
That's good advice.
So it's more like
Yeah.
timing's more important, more so than just
Absolutely.
spending the money just to spend the money.
That's good.
So that's probably another big thing with your personal taxes is just timing.
Yeah.
It's not just a April 15th ordeal. It's an all year ordeal.
Yeah. I mean, it's,
Lots to think about.
yes, exactly.
I've learned a lot today, actually.
Yeah.
You're welcome.
I learned that I can't write my Botox off.
Sorry.
Any other big tips or advice for people looking to get their taxes done in the new year? Like, what should they do now to prepare, or what advice would you leave with people for?
I think organization again is the key. You don't want to miss anything, and so if you're thinking continuously about I spent money on whatever, this might be deductible, and if you're unsure if it's deductible, stick it in the folder and then have that conversation with your tax advisor. But don't think just, well, this isn't deductible, so I'm not going to, because it might be, and so. Just always err on the side of caution of I'm just going to stick this in the tax folder and we'll have a conversation later. But just organization is the key. You might even want to pull out last year's tax return and the tax preparer will give you your documents back. So even if you don't have your organizer yet or your tax advisor doesn't use an organizer, look through what documents you had a year ago and make sure you've got those ready, and even make your own checklist. But organization is just so key for you to make sure you give your advisor everything that you need to give them, and for them, because it will make their job and life so much easier at a time when not everybody is making their lives easier.
Yeah.
And definitely that would be the best way to keep your tax prep fee down and to give you the best result is to be organized.
Good advice.
Really good. How long should we keep our taxes for? 7 years.
7 years for tax docs. For the actual returns themselves, you're supposed to keep those forever.
Ooh, I have a question.
Really?
How far back can an auditor look?
Depends.
If you get pulled, like something's going on, they want to look, doesn't even have to be suspicious, but if you get audited, how back do they look? Far back do they look?
They can go back. The reason we say keep everything 7 years is that's usually a good benchmark. 5 to 7 years is about how far they'll back, unless they are suspicious of fraud, and then they can go back forever. Mm. So if they find fraud on a return they pulled for just a regular examination, they will maybe want to go back further than that and see if there's a pattern of fraud, and they can go back forever if they believe you've committed fraud and can prove that. So. So don't commit fraud.
No.
Report all your income.
If you take anything away
Final
from this
advice.
episode, don't commit tax fraud.
Yes.
Yeah.
Nobody looks good in orange.
That's right.
Well, thanks for being on again with us, Matt. This has been great.
Yeah, thank you so much, and we'll see you next time.
So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. We'll see you next week.
See you next week.